All right, alchemists. Today we're taking it to the next level. After our last session on building an ESG driven single family office, I had a lot of requests to take it deeper. So here it is. This is your week 6 deep dive. We're going to build a $100 million family office around ESG investing. It's built on high tech financial modeling, legal infrastructure, ESG metrics, and cyber compliance ready for the 2030s global economy. We'll look at tactics, tech, and the playbook. If that sounds good, let's get into it. First, the vision. A family office is a decentralized sovereign wealth engine where values shape value. That means starting with your core beliefs and then designing a structure to make sure those beliefs are honored. And just so we're aligned, ESG stands for environmental, social, and governance. It's about making sure that your money is not just generating returns, but also contributing to a better future for everyone. Okay, so let's start there. What are the key pillars of this family office? First, legacy and succession planning. How will the wealth be passed down to future generations and managed over time? This is best done through a series of legally binding agreements called trusts. You set up the rules once and they protect your loved ones forever. Next, long-term capital preservation. It's about keeping and growing your wealth for the long haul. We'll do this by diversifying across asset classes and geographies. Third, ESG-aligned wealth deployment. Putting your money to work in ways that reflect your values and make a positive impact. Finally, governance, compliance, and cybersecurity. Ensuring everything runs smoothly and securely. So now that we have our pillars, let's design the structure. We need a 4-layered approach that allows us to balance risk, return, and impact while complying with global regulations. Here's how it looks. The first layer is the private trust company, or PTC. This company is established in a jurisdiction like Cayman, Singapore, or South Dakota. Its role is to hold and manage the assets for the benefit of the beneficiaries as defined in the trust document. Importantly, the PTC is separate from the owners of the company, which are the beneficiaries of the trust. This creates a firewall between the trust assets and personal liabilities of the beneficiaries. Additionally, the PTC has full decision-making authority regarding investments and distributions from the trust. It can enter into contracts, buy and sell assets, and distribute income, all in accordance with the terms of the trust. The PTC's board of directors, which is separate from the beneficiaries, oversees the trust management. This board ensures that the PTC acts in the best interest of the beneficiaries and complies with all relevant laws and regulations. The board typically consists of experienced professionals such as lawyers, bankers, and trustees who are not related to the beneficiaries. Layer 2 is the investment holding company. It's domiciled in a place like Liechtenstein, Singapore, or London. It owns the shares of the PTC and is responsible for the overall direction of the group. The holding company is also where we optimize taxes globally. The third layer is the philanthropic arm. Whether it's a DAF or a foundation based in Delaware or Geneva, this entity manages and distributes grants in line with the family's ESG goals. Finally, layer 4 is the Impact Investment Fund. It's a Luxembourg RAIF, or a B Corp structure, investing in companies that advance environmental or social objectives. With our structure complete, let's look at the financial engineering and math models behind maximizing risk-adjusted returns with ESG integration. Remember, risk is the standard deviation of returns, and higher risk means more ups and downs in your portfolio's value. Now our goal is to find the optimal weight for each of the 4 classes of assets, C1 through C4. C1 is public equities, specifically ESG-focused index funds. C2 is private equity, targeting climate-focused businesses in healthcare, for example. C3 includes green bonds and climate-linked securities. Finally, C4 represents the philanthropic capital, which doesn't seek returns but aims to maximize impact. So how do we find the best mix of these assets? We use a model called U sub P, which calculates the utility of the portfolio, or the idea is to balance expected returns against risk. The formula looks complex, but it's straightforward. It takes the sum of the product of each asset's weight, its expected return, and a factor that adjusts for risk. The risk is calculated as the standard deviation of the asset returns. The cool thing is that we can use calculus to find the optimal weights that maximize UP. And if you're wondering about the funky E notation, don't worry, it's just fancy math for expectation, kind of like the average. Now let's talk about constraints. First, we want to make sure the weights add up to 1, meaning 100% allocation. Second, we don't want philanthropic spending to exceed 20% of the portfolio. With these constraints in place, we have a proper risk-weighted allocation model that helps us find the optimal mix of assets to maximize returns while accounting for risk and aligning with our ESG goals. To make things even cooler, we can use Monte Carlo simulations to compare long-term return variance with the ESG impact score. Just think about it. By plugging in different scenarios and probabilities, we can see how well our portfolio might perform under various market conditions while also measuring its ESG impact. Pretty neat, right? Next, we need to ensure legal, tax, and cyber law compliance across jurisdictions. We've chosen Singapore, Liechtenstein, London, and Delaware for their robust legal frameworks and favorable tax regimes. But there are many other options depending on your needs. The key is to diversify your structure to minimize risks and maximize efficiency. When it comes to regulation, we need to comply with SFDR, which is the EU Sustainable Finance Disclosure Reg, GDPR and PDPA for private client data protection, and MiCA, the EU crypto regulation, plus additional guidelines on digital assets and cyber resilience. And let's not forget about international standards like ISO 27001 and NIST 853 for family office IT stacks. Finally, we need to make sure that our technology is secure. Encrypted infrastructure protects our data, and digital vaults safeguard important files like IP, wills, and KYC info. In short, compliance isn't just about following rules, it's about building a sustainable and responsible business. Speaking of responsibility, let's talk about philanthropy. Our DAF tax shield lets us reduce taxes while making a bigger impact. It's a win-win. And hey, remember how we mentioned green bonds and CLNs in our risk model? Well, they're a great way to get market-linked returns while supporting ESG goals. Plus, blended finance combines philanthropic and commercial capital in separate accounts within an SPV. Then there are tactical allocations like venture capital or growth equity in the impact space. And finally, we can use AI and blockchain to track ESG performance in real time and even use DAOs for more transparent grant making. Okay, alchemists, we've covered a lot. Let's quickly recap our 4-layered structure and the tactics we can use to build our $100 million ESG-focused family office. So what have we learned? First, we need to start with a clear vision and values. What do we want to achieve and how will we measure success? Next, we should consider the structure. A 4-layered approach can help us balance risk, return, and impact while complying with global regulations. Then we need to look at the finance. Our risk model maximizes returns while considering risk and ESG factors. And don't forget about the importance of compliance and cybersecurity. Technology can help us streamline processes and enhance transparency. Finally, we shouldn't overlook philanthropy. There are various tools and strategies to maximize our impact. It's a lot to consider, but remember, it's a journey, not a sprint. Take your time, do your research, and build a family office that reflects your values and sets you up for success in the long run. That's it for this week's deep dive. I hope you found it helpful. If you want this package as a visual dashboard, an executive white paper, or an operational playbook with templates, let me know. I'm here to help you navigate this exciting world of ESG investing. Until next time, happy investing, and thanks for joining me on this journey towards a better future.